Welcome to the Eurex Access to Global Markets using MSCI Derivatives Focus Day. My name is Will Mitting. I'm founder of Acuity, and I will be moderating the event today. Over the next 2 hours, we're going to be covering a range of topics related to the MSCI product suite, from the growth of the options market to trading the Middle East to opportunities in total return futures on the MSCI indices. This webcast will be held under the Chatham House rule, so please can any media dialing in check quotes with speakers prior to anything being published. We do encourage you also to ask questions throughout the discussions. Please do so via the question portal on your screen, and I will put them to the panelists. So without further ado, we're going to kick off with our first speaker. So I want to welcome now Ralf Huthman, who's Equity and Index Product Design at Eurex, who's going to be covering some of the motivations for the launch of the products, looking at the current uptake before taking a look at how to grow the overall ecosystem. Ralf, welcome to the webcast.
Thank you, Will, and good afternoon, everyone.
So Ralf, if you just start at the beginning, tell me a little bit about the initial drivers to list MSCI on Eurex.
Yes, with pleasure. So we started the whole initiative roughly 10 years ago. So in 2013, we had a broader listing of MSCI futures. That was based on our request or our wish, basically, as Eurex to develop outside Europe. Back then, almost all our index-related volume and open interest was in German, Swiss, and European products, and we wanted to extend that further outside Europe. And that came nicely together with a request from a client who saw the same wish as we to develop outside Europe and also go away from OTC products more into the listed space.
Interesting. And why MSCI? What did MSCI specifically bring that you didn't have already?
Well, we have a good index provider in-house with stocks, so nothing wrong with them. But historically, they have been very much focusing on Europe and European indices, which had also to do with their way they were created. And MSCI is just in asset terms, the leading index provider on global indices. So up to now, they have roughly $16 trillion benchmarked to their indices, and especially they are the leading index provider when it comes to regional indices. So most index providers have a very strong focus in one country, whereas MSCI has a very strong foothold in this global/regional indices. Therefore, it was an easy choice for us to also go with MSCI, even though it's not our main index provider. But we thought before the same products are developed by another exchange, why not on our platform?
Absolutely. And what were the trends that you saw in the market that led to the list? And I know you've got a great slide here to kind of talk through some of the key points in that respect.
Yeah, I mean, basically 3 trends I would like to mention here. So we have the long-lasting trend towards passive investments. So more and more money is invested that way because many asset managers have not been really able in the long run to beat benchmarks. Therefore, I think we have seen this tremendous growth in the ETF space as well. Then we have also the trend to more global portfolios, and I think we come to that also at a later point again. There's just a fundamental shift in many investment markets from national to regional or global indices. And last but not least, there was this trend away from OTC products into the listed space. There was not so much already in 2013 when we have started our endeavor here, but it came in strongly since 2016 with uncleared margin rules, which have been a major driver for our segment.
Interesting. So it was replacing a kind of big OTC product, and you've seen that shift from OTC into the markets.
Yes, yeah, it's basically a 2-step shift we have observed there. So it was first the banks who have started to push out of swaps into futures, also to get better margin offsets and margin efficiencies. And the end clients, which are the main users of MSCI benchmarks, they are following a bit later. And this is also where we would expect additional growth to come for this segment.
Interesting. And on the subject of growth, if you can talk a bit about how the products have developed over time and the steps you took to build the order book.
Yeah, maybe for that we go to the next slide where you can see what we have achieved over that 10 years, and you see a very linear growth in volumes, and also similarly on open interest. So we are just looking at that graph, of course, quite happy, but going back also to that figure of 16 trillion assets under management linked to MSCI indices, we would expect that over time there's enough potential to grow further. But in general, we are mostly pleased here because we were not the only ones and the first ones who have listed MSCI derivatives. When we started, there was already basically in all three time zones a different competitor active with different approaches. There was the ICE US with just 2 products, but very much order book focused. Then we had the Live in London with a more or less cleared only approach. And back then also Singapore was a third exchange. So given that we were basically a bit late to the party, it's of course a great success here that we are today #1 in open interest with roughly 160 billion euros in terms of open interest. So this is great to see, as well as the products you see on the right-hand side, which contribute to that success. So it's, of course, the normal benchmarks you see there, so like the MSCI World, MSCI Europe, but you also see some products which you may not expect here for a European exchange. So EM Asia being our biggest product on the future side, or China, Japan, and India have a substantial open interest these days. So therefore, that is quite good. And I think it comes down to some selling points we had when we started here, being at a very broad and comprehensive product offering, or a focus really to build up order books, but at the same time also allow block trading in a customer-friendly way.
Interesting. And that shift to order book trading, kind of how did the order book build over time, and where are you now in terms of the kind of on-screen volumes? Yeah,
we thought one of the selling points for our offering would be really to have good order books. So over time, we spent a lot of incentives to get market makers on board. And maybe worth to mention here that all our MSCI futures are offered during the whole Eurex trading day, which spans from the Asian hours up until the end of the US hours. And we try to have market makers in all three time zones. So we have developed certain schemes for that and see good traction there. And that has now translated into some products really at that point where they become order book products. I think we will see that on another slide, but you have now some products like MSCI World or also MSCI China really trading hundreds of times per day. And this is to a large extent also down to the market makers. But at the same time, we also have worked with the other players here in the market, like the brokers, the banks, and the end clients, to combinedly grow that segment in all dimensions.
Interesting. And you mentioned that OI is now bigger on Eurex despite launching. Obviously, the strength of the order book is one key factor in that. But you were a relatively latecomer, as you mentioned. There was existing contracts, but your OI is now higher. Why is that, do you think?
I think we had a good mix here of products. So first of all, we decided that we need to have a very broad product coverage. And maybe for that, we can have a look into the next slide. We, for example, decided we need to have something different, what the other exchanges have not had at that time. And MSCI is an index provider which works a lot with a toolbox of products, and you can break it down into certain elements. First of all, of course, the countries. And our approach was to list basically all individual countries as individual future products on Eurex, which are part either of the MSCI World, so the developed markets, or the emerging markets. So we have today, I think, almost 50 country indices, which allow then also market participants like asset managers to overweight or underweight certain products, and not being forced to go to the individual exchanges and trade the products there, which of course then for the banks again gives some cross-margin benefits if you have everything in one exchange. And I think this product mix, where I just mentioned the countries, but also on a regional basis, we have added products like EM Asia, EM Latin America, and EM EMEA, where before there was only an EM product. I think that has also played a massive role here in the success, because that allows then the banks to break down the risks and trade them in the individual trading locations, so that the Asian part is traded out of Hong Kong or Singapore, and the US part out of New York typically. So these were all products which were not there at the beginning. And based on the success of the segment, we have then moved on and added further products over time.
Interesting, and I guess it's allowed kind of European investors to diversify and move away from a home bias as well. So, what's been the feedback from clients in terms of how it's enabled them to expand their exposures?
Yeah, in general, this product offering really has opened our doors also on the client side in all regions where we have been seen as a European exchange beforehand. And as I said before this, or what you mentioned with home bias, is this trend of going towards more global portfolios. So just for illustration, when we started in 2013, when you look into, for example, the ETF market in Europe, or etc., which is the largest ETF market in Europe, then you have seen that more than 50% was invested in German or European ETFs. These days, this has gone down to just 20%, and more than, I think, 60% are now invested in global or US-based ETFs. So this underlies a bit this shift away from this home bias, and having this full list of products available for each country, of course, allows clients from all over the world to use Eurex, especially as we cover the whole trading day. So this is appreciated, and we are growing our end client bases more and more on that.
Interesting. And you mentioned obviously the need for more granular EM products, but within MSCI World, there's now the development towards the natural extensions into factors and other granularity within the parent index. So what are the key trends there? What are you seeing there?
Yeah, what I described so far, this breakdown of EM into the different regions, that was more something which has helped the banks to optimize their trading pattern. So there we have done something in particular for the banks, but we are also trying to build products in particular for end clients. And end clients have a different view. They want to have their benchmarks like MSCI World traded, but they sometimes also want to outperform that benchmark. And there, of course, certain products like factor indices can help, where you have a minimum volatility approach or quality index. And here again, the success we had already in MSCI World boils down into those products which are derived from that parent index. So we can slice and dice basically an MSCI World index not only into the countries as mentioned, but also into different sizes like large cap, mid cap, small cap. We can slice it into sectors, or we can come up with products like factor indices, which are used to outperform in certain market environments. So that is well received and is just a different clientele we want to reach with those products. There, for example, order book is not so important, but they have just a need that banks are in a position to offer good prices in the OTC market.
Interesting. And you talked about the kind of global ecosystem, so in terms of kind of banks being able to trade in their own time zones, but how global is it now? What are you seeing in terms of liquidity and flows throughout the global business day?
So first of all, MSCI World is really the cornerstone here in our segment. So that is, and we see on the next slide how that has developed in a sense that over time, I think it's the green line here, the MSCI World Future in US dollars, how the liquidity picture has improved more and more. There was some peaks again when COVID happened, of course, where liquidity has gone away. But in general, there's a trend that the order books are getting better and better. And that is also reflected then in the number of trades, where you see on the right-hand side, especially MSCI World, which now trades 100,000 times a month. And in October, we have seen a similar picture in the China index. So the liquidity in certain products is really getting better. They are turning into order book products over time. But it's still very much in most of the products, also because we have the highest number of market makers here, it's still in the European products where we have the highest liquidity. But when we look into block markets, there you see that a lot business also goes via the Asian hours, as well as to a smaller extent in the US hours. So this is another trend which we observed that many people want to trade MSCI indices based on the closing levels, and they can then enter that in the Asian morning once the index levels are available. We see a lot of trading going through, but I think in general, it has helped us to become more global as Eurex, not only with a product offering, but also how volumes are split during the day. But still, MSCI is only a portion of our volume. So our open interest has developed better than our volume, and therefore we hope to see much more growth to come further forward.
Interesting. And in terms of the granularity of the product, how do you see that developing going forward?
Right now, we have already 169 something futures listed at Eurex. So basically, the main products are covered, I would say. So we have even an MSCI World listed in dollar, in euro, in British pound, and sometimes as a price index and net total return index. So I don't expect that we are permanently adding more products. It's more now really developing that products further with getting additional clients in. And we see a certain trend towards customization. So more people are asking for bespoke solutions. So that could be a way of further developing in a market where you have already listed most of the interesting products. So it could be that the next launches are rather than covering some niches or some shades of ESG or climate indices. Those are the developments I would see on the product side.
Fantastic. Interesting. Well, thank you ever so much, Ralph. That's provided a great introduction to some of the key themes we're going to be discussing today. So thank you very much to Ralph. And we're now moving on to the second discussion, which is a fireside chat with Mej Kabul, Head of Business Development and Sales APAC at the Middle East for Eurex, and Puneet Gupta of Goldman Sachs. So we're going to be looking this session on MSCI specific to Asia and the Middle East. Ralph obviously mentioned the development of EM and its reach into regional markets. But Mej, perhaps if we could begin with you again, just some of the background to the launch. Why did you launch MSCI contracts for Asia and the Middle East?
Yeah, thanks, Will. I mean, we started launching the Asia-related products as early as 2009. I believe as we observed really a growth in the region, particularly Asia at the time. and we continue to expand on this offering from 2013 onwards. We wanted to provide investors more opportunities to gain exposure to this dynamic and growing market, which continues to grow to this day, despite some of the uncertainties that we see. And by offering the contracts, we diversified their investment options into developed, emerging frontier markets, which is extremely important for their portfolio. It enhances market liquidity. The introduction of these contracts increases trading and liquidity in these regions, which is also making it easier for investors to enter and exit positions. There's also additional tools for hedging and managing risk. Some of the countries in these regions can be quite volatile, which we are seeing today in the news every day, and can be quite unpredictable at times as well. So that risk management and hedging side of it was extremely important, which is also why we focus on some of these. And we also wanted to attract a wider range of global investors, which is why we have our products also trading around the clock, as Ralph also mentioned earlier, with counterparties from US, Europe, Asia Pacific and Middle East. But more importantly, we also started to offer these products just given the growth potential of these regions. Countries like China, India, Saudi Arabia, they've got a significant growth potential coming up and already achieved due to their larger growing population, but also the expanding middle class and ongoing economic reforms, which they're all concentrating on. But we also adapted our launches to make sure that we fit market sentiment and trends. So, for example, in 2023, clients were talking more and more about getting exposure to Vietnam, which is when we launched our MSCI Vietnam contract. There was a boom in tech-related investments in 2021, which is then we looked at MSCI China Tech as example. And when sustainability became a bigger focus, we then looked to introduce ESG-related products like MSCI Japan screened futures. And more recently, we also renewed our partnership with Tadawul to be the only exchange to offer Saudi Arabia futures and options. Ralph also in his presentation mentioned, but we are globally #1 exchange now, and the Asia Pacific and Middle East contracts, whether it's regional or single country names, provides a significant part of that as well.
Interesting. Thanks for that. And in terms of the interest and activity from your clients, where are you seeing the most flow in the Asia and Middle East contracts?
I mean, Asia has experienced, I'll just concentrate on Asia first, remarkable growth over the past decade, driven by several factors. The main one being economic expansion. China, India, Vietnam, they've seen significant GDP growth. And despite the slowdown, China continues to be a major economic powerhouse, and India is now projected to become the world's third largest economy by 2030. This is also reflected in what we see in terms of the top traded products on Eurex, for example, India, Japan, Taiwan, China, and they also have the highest weightings in the regional contract of MSCI EM Asia, which is close to 21 billion euros in open interest at the moment as well. Similarly, Middle East has experienced and continues to have varied growth over the past decade. And moving forward, it's also predicted that the economic growth in the GCC is going to rebound to 2.8 to 4.7% in 24 and 25. This is attributed to a few factors, including, recovering in oil output, but at the same time diversifying away from oil and putting more into investments such as tourism, renewable energy, financial services, etc. Naturally, there are some potential headwinds here, including the escalating regional conflicts, which is undermining investor confidence at the moment. It's disrupting trade, it's impeding growth. And there's also some fiscal vulnerabilities as well due to the volatility in the oil prices. But overall, there is growth, and our MSCI Saudi Arabia, UAE, Kuwait, Qatar, Israel have made it possible for our clients to be able to navigate these uncertainties and hedge themselves.
Interesting. And we saw the sell-off in China over the summer. How did that impact flows?
Yeah, it was quite interesting, actually. At the start of the sell-off, obviously there was significant impact on the flow on MSCI China contract. However, we did see, although we saw the decline in the China contract, there was a shift of sentiment to MSCI Japan, where we now have open interest of 8.7 billion euros. But then the biggest shift then started to be into MSCI India, which has reached about 11.9 billion, I think, in open interest at the moment. We are now seeing China bouncing back, given the stimulus package that was announced in September by the government to support the economy. But also on the side, MSCI Malaysia, Indonesia, Thailand, these are also picking up as investors look to diversify a little bit away from India and China, which they are very heavily invested in at the moment. I mean, throughout the sell-off period, we did have robust liquidity, including in the order book. And today, MSCI China trades about 25% in the order book. And this is, of course, thanks to our market makers and the support of the Delta Ones during the roll, where they also populate the screens and calendar spreads. And then, of course, the dynamic IDB partners we work with to bring all the counterparties together.
And you mentioned some of the risks earlier that you see requiring the need to hedge. But if you look beyond that, what factors do you see driving investment in the Middle East in the kind of medium and longer term?
Yeah, I mean, there are several factors. There's economic diversifications. Saudi Arabia, UAE, they're moving away from oil dependency. They're investing in sectors like tourism, finance, technology, which I mentioned earlier. The region is also a strategic geographic location, whether it's time zone wise or where its location is in the proximity to Asia and to Europe, as an example, which makes it key player in the global trade and investment sphere. They have comprehensive economic and regulatory reforms, which also includes privatization initiatives, infrastructure development, and this has created a more favorable business environment, if you like, which is also why we see a massive shift of investors moving to the Middle East, particularly UAE and Saudi Arabia. And the domestic exchanges are also putting more importance on derivatives-related products, which is also why Tadawul has partnered with Eurex to offer MSCI Saudi futures and options to our global client base. There's also relative political stability in some of the countries, despite what we're seeing, which is also boosting the confidence in this region. And the growth opportunities, which I mentioned to you, I think is just going to continue, whether that's through digital transformation, sustainable development, the middle class growing, and so on and so forth. It's projected to continue to grow, and from my perspective, as they shift away from oil investments, I think the financial markets is going to have a massive knock-on effect on the usage of the futures and options in this region, which is great since we've got all the products such as UAE, Kuwait, Qatar, Saudi Arabia, etc. already listed on Eurex.
Interesting. And before we move on to bring Puneet into the chat, what can be expected in terms of the kind of Asia underlying futures on Eurex in the coming years?
Yeah, I mean, I don't have a crystal ball to predict it completely, but obviously we work very closely together with our partners, with MSCI, with the market, etc. And just given some of the sentiments I shared earlier today, I mean, there is going to be increased trading activity in these contracts, with the extension of trading hours that we also implemented to be able to trade these products around the clock. We can anticipate further volume coming, including from the Asia investor base and the Middle East investor base. We also have diversification of products in the pipeline. We're looking to introduce new futures and options products, including more regional and country-specific indices, as well as sustainability ones. We do target hard-to-access markets. I mean, this has been a pain point for a lot of our clients to be able to access certain markets that have limitations or restrictions or challenges to go. So this will also be a focus for us to gain more momentum in. And of course, cost of trading is going to continue to be taken into account for us, and the margin offsets to ensure that our global client base also have adequate risk management and hedging tools in place for them.
Fantastic. Well, thank you very much, Maj. That's a great introduction to the product. So, Puneet, I want to bring you in now. From your perspective, how have you seen liquidity build in the contracts? Oh, you're on mute, Puneet.
You're still on mute, yeah.
Yeah.
I can hear you.
We can't hear you. So, Praneet, I think we're going to try and get you off mute, but Mej, let's come back to you while we unmute Praneet. On the liquidity question, however, from your perspective, from the exchange perspective, how's it evolved over recent years?
Liquidity for us have increased in the Asia and Middle East products. I mean, that some of the top traded products for us, obviously, outside of world, Europe, etc., is Asia-related products. And here, where we see sort of some of the global contracts sort of decreasing, I would say our Asia underlying futures have sort of kept us being the #1 in terms of open interest and so on. But similarly, outside of Asia, I mean, Latin America and other global contracts have also brought some good liquidity to the platform. Ralph also mentioned earlier, the #1 contract for us is EM Asia. I mean, it's traded significantly. We have, now there are sentiments in the market that, this product is liquid, but it's too heavy with China weightings in there. And so how MSCI is now going to look at this in terms of maybe reducing the China weighting, increasing India, etc., is to be seen. But we do envisage that there might be some changes there coming. I don't think that will affect the liquidity necessarily, but it will affect obviously how investors are trading those contracts.
Interesting. And as an exchange, I guess you've had a lot of incentives in place to build on-screen liquidity. How's that evolved now, and how liquid is the on-screen market today?
Yeah, in some of our contracts, I mean, outside of the Asia ones, at the top of my head, I mean, MSCI World now trades about 50% in the order book. This is very much sort of a sentiment of the great partnerships that we have with our liquidity providers, with the Delta Ones as well, which I mentioned earlier. And then if you look at other countries on a single basis, like China, MSCI China, over the years where it was, 95% or 90% block traded, it's now 75% block traded. I think there is a need to continue growing that liquidity in the order book, and we're continuing to do what we need to do with our partners to achieve that.
Fantastic. Thanks, Mej. I think we've got Praneet back now. I think we can.
Sorry, am I audible now?
Can we hear you now?
Yes, can you hear me?
It still looks muted to me.
Sorry, the audio test seems to be working off the event. I'm not sure why.
Sorry, I think we still have a technical issue with Praneet. So, Mej, okay, I've been told that he can be heard, but we can't hear him. So while we sort that out, Mej, sorry, I'll come back to you again just on the liquidity. I mean, as you've seen the liquidity build, has that enabled new client types to come in? Have you seen a mix of client types? I know you don't have total visibility into the end user, but how's that ecosystem evolved?
Yeah, it's a very good question. I mean, we initially it was quite sell side heavy, I would say, with the liquidity picture that we had. But over the years, globally and not just in Asia, we have worked very closely with the end investors, with the real money, with the asset management firms, etc., in order to sort of bring in a diversified pool of investors and clients to the table. I mean, there was also the shift with the UMR, so the uncleared margin rules that came in as well. There was the shift of pensions coming in more and more to trade these products, moving away from the swaps and OTC market. In Asia in particular, where we have seen the biggest growth now would be from the pension funds or superannuations in Australia. So we continue to work closely with them on this.
Fantastic. I think we do have you now. I can hear a noise. Praneet, do you?
Yes, I can hear you. Are you able to hear me?
Perfect. Yes, we can hear you loud and clear. That's great. Apologies for the slight technical issues there. So Mej was just talking about the liquidity build that we've seen and the kind of growth of client types. But from your perspective, how busy has the market got, and what's changed as liquidity built?
Well, we are very busy with the MSCI product. It has always been a product that's been a focus for sell-side firms in the index financing Delta One space. And I would say that, if anything, on an empirical basis, we're devoting more headcount, more mind share to the product. Obviously, Ralph kind of ran through the numbers that the overall, volumes have gone up by about 40%, 18% year on year. I think within the Asian space, it feels like it's probably more in the 20-24% region in terms of what we see volumes going through Asia and on our desk as well. What's interesting is that a few years ago, the clients were mostly interested in the regional or the global level contracts, and the country contracts were largely used between dealers as a way to move funding from one channel to the other, or move inventory from one channel to the other. However, we are seeing clients now step into country contracts. I think, as Mel mentioned, into growth markets like China, India, Saudi Arabia, etc. And the growth in volume has happened at a time when, there's been a challenged investment landscape in China. So if that reverses and the interest comes back in, we can only see that growing further. I think the other, again, I guess, so the client base, the historical client base has been pensions, insurance companies, asset managers, real money asset managers, etc. But we are seeing more flow come to our desk through market makers who are providing liquidity on the screen and then recycling that risk with us. We are seeing more hedging flow from quants, especially in markets where there isn't that easy an access to the short side of the market, either through restrictions in stock loan or lack of inventory, etc. So seeing increased volumes there as well.
Interesting. So kind of an increasingly diversified trading ecosystem. And then Ralph in his introduction talked a little bit about the global appeal, how trading in different time zones is increasing. But how do you perceive the current demand for MSCI futures in APAC, and what are the key trends you're seeing in that respect?
So we are seeing an increased participation from Asia clients for sure. And again, coming to the global nature, I think one thing we're seeing more of is that clients in Asia who used to traditionally look only at trading in the order book in the US are now increasingly looking at seeing whether they can access futures on risk, for example, in Asian hours, through dealers such as ourselves who have global desks and are aligned globally so that, we can provide prices in Asian hours and hedge them globally. So that's one trend that we're seeing. Another trend that we're seeing is a demand for slightly differentiated products. So we are seeing more interest in things like MSCI World Min-Wall version. We have seen interest in I know this product doesn't exchange on this exchange, but like a lot of EMX China is another product that we have seen growth in the MSCI space. And again, the other trend that we've seen quite a lot of is just that at the client level, there is an increased focus on cost reduction, on building leverage, on optimizing their portfolios. And we're seeing a lot of flow that's coming not just from taking directional exposure, but also in terms of trying to figure out what's the best way to get into the beta and what's the best way to replicate beta. Is there a more cost-effective way to gain the exposures? And we're seeing a lot of more interest from that from our institutional client base.
Interesting. And in terms of kind of what's driving demand, is there any recent regulatory changes that have influenced trading strategies, and what can we anticipate is coming down the pipes in that respect?
So definitely, I think there's been a broad trend towards futurization led by regulatory changes. And while there are a whole bunch of them that have affected the space, I would say that I would call out a couple in particular. One is the UMR rules, which have made it more punitive in the sense that the OTC product now requires both counterparties to post margin and predominantly cash margin against their cleared OTC derivatives. That obviously in a capital constrained environment is an expensive proposition. And so the future product, where there's a standard margin contract, where there are margin offsets, where there's an ability to post differentiated collateral as margin, is obviously more appealing. And the second set of regulations, which include MiFID but include others as well, have just made it more operationally intensive to do OTC products, given that the burden on reporting, the burden on valuation metrics, and providing information to clients in different formats has increased. And so a standardized, futurized product with flexible margin and easy operations have definitely been very appealing, leading to the futurization.
Interesting. And we've talked a lot about the kind of breadth of the product suite, but it covers now kind of numerous markets across the Asian and Middle East region. But are there any areas that are missing? Are there any holes you think that could be filled?
Yeah, so I would say you could look at this from a product lens or a geographic lens. From a product lens, and this is not missing because obviously Eurex has launched TRFs on MSCI products very recently. It's yet to kind of pick up full steam, but I think that, again, coming back to the regulatory point, given that OTC swaps are becoming more expensive and capital intensive, if you see the TRFs as a replacement for the swap product, where clients can get swap-like exposure to total return contracts, we do think it is appealing, and we do believe that as clients build up the operational capability to handle these contracts, and as dealers build up the education around these products with the clients, we will see a pickup in the TRF space. I think if you look at it from a geographic lens, I mean, there are clearly some geographies where, which are large and material weights in global indices where we do not have futures products. MSCI Korea stands out as one obvious one. MSCI China, there are certain contracts for sure, but the product suite is limited globally across exchanges due to a variety of regulatory constraints. I think having a broader set of China tools, given how liquid and broad that market is, there's scope for new products in China. And then lastly, in India, where there's a lot of demand as well, there is an MSCI India contract which is extremely popular on Eurex, but it also is predominantly just a large cap contract. There is interest, given that it's now a $4.5 trillion market cap economy, for things that go into the mid cap and small cap space.
Interesting. And in terms of the growth of the MSCI futures and options over the next few years in Asia, what factors do you think will drive that, and how much growth are you expecting in the product?
Look, I think firstly, we will have natural organic growth. We do see interest building up. We see an increased use of derivatives, as you mentioned. The markets themselves are growing, which will give a beta to the growth, both in the Middle East and in Asia. So I think first there will be a natural level of growth, which we will all benefit from. Over and above that, I think one key game changer, which has been referred to, is the order book liquidity. Clearly, there are some clients that will use futures only in markets or only on venues where there is already order book liquidity. Definitely, there are some clients in the quant community, in the sovereign wealth fund community, that use order book liquidity as a condition or criteria to choose where they trade. And so liquidity begets liquidity, and the more that we see that order book developing, the more we see adoption of the futures product.
Yeah, interesting. And a related question to the liquidity is, you mentioned the kind of UMR and the futurization that has seen a lot of these previously OTC contracts coming on screen. But the trading of these products is still largely OTC in nature. How's that holding back the volume development in the listed markets?
Yeah, so I think, if you examine the reasons why some of them are still OTC in nature, I would say the first one just simply is that it takes time for people to change their habits, their operational models. A lot of these clients, obviously, a lot of our clients operate through implementation teams or trading teams, some of which are sometimes split between the teams that handle OTC products and handle futures products. So a lot of it comes down to just, the adoption of futures products over a period of time. I think the UMR regulations will push it in that direction, and so will the development of products such as the TRF. And then finally, seeing order book liquidity will also kind of remove the last sort of holdbacks in the way that some clients perceive the product to be a less liquid product. So a combination of those factors, I think, will finally lead to more futurization. I think the incentives are there, and the trend should continue in the same direction.
Yeah, absolutely. And I guess kind of tighter on-screen prices and deeper order books will just attract new entrants to the market. But also with larger block size minimums, do you think would that also help or hinder volume development?
I mean, it's to be seen. I mean, I think you can argue it both ways. It's useful to have a larger minimum block size. From our perspective, from operational perspective, it's not clear whether one cannibalizes the other. I mean, I think if there is a need for order book liquidity from a client, there's a need for order book liquidity, and having smaller block sizes is not necessarily going to replace that. So it would obviously be, I guess experimenting in time will tell, but I don't necessarily think that one cannibalizes the other. I think there's just different use case.
Yeah, fantastic. Well, thank you very much, Puneet. I don't know, Meg, do you want to just finish off with any final thoughts or a summary before we hand over to the next panel?
Keep trading MSCI on Europe, I guess.
Perfect. Puneet, any more thoughts from your side?
No, I mean, I think along the similar lines. I mean, it's a great product for clients. We love the product innovation that comes out from Eurex, and we're going to continue being at the forefront of providing liquidity in markets where we can.
Fantastic. Well, thank you very much for your time. That was a fascinating discussion, and apologies for the slight technical problems, but I'm glad we worked through those. So we now turn from Middle East and Asia to options markets, the options volume under the MSCI product suite. So joining me to discuss this element of the market is Rachna Mathur, head of equity and index sales in America at Eurex, and Nicolas Lalou, MSCI options trading at BNP Paribas. Welcome, both of you. So Rachna, I was wondering, we'll come to you first. If we're looking at the options market under the MSCI suite, where have you seen trading develop, and where's the most growth been over the past 5 years?
Hi, Will. Thanks. Good afternoon. Good morning, everyone. So both Mesh and Ralph in the previous two panels talked about, the growth of the MSCI business on Eurex from the futures lens and also from the Asia perspective. And so we introduced along with it our third wrapper, which is the option segment. So that clients have the variety to trade futures, options in different wrappers as they please. You can see on the slide, I mean, the whole segment has seen tremendous growth ever since we launched it in the end of, like 2018. And the segment has basically now grown to become almost 29 billion in notional open interest. So the growth has come largely in segments on developed markets. It used to be MSCI World till 2023, and now it's progressed more towards the EFA index, which is basically everything ex-US in the developed market segment, and then also on MSCI emerging markets, which has really seen flagship growth. And this is sort of carries on to what Puneet and Mesh just spoke about, the growth that you see in Asia, Middle East. So the EM segment is obviously very biased towards Asia. So that's been sort of the growth drivers. The regions here, unlike what we've seen in the previous two panels that was discussed, the growth here is mostly on regional indexes. The countries are yet to pick up, because domestic country markets are still pretty dominant in the option space. The regions is what drives volume and business here, both again, EM and EFA and world to some extent. This is also, again, Puneet mentioned it a little bit, what's driving clients is cost considerations, moving it to listed platforms. So options basically offer a much cheaper way to get the exposure that you're looking for in these regions.
And is that, that's obviously a key efficiency for clients, but what are the market efficiencies do options bring to the table? Yeah,
so I mean, options on a listed space is a whole different ballgame, right? So the first thing is the low cost of trading. So the equivalent of a listed options market in the MSCI segment is the US ETF options market. And if you compare US ETF options to index options that we list, ours are significantly cheaper, almost by bips and Vega to trade on Eurex versus US ETFs. Then you have capital efficiencies. Exchanges and clearinghouses like ours offer margin benefits, whether you trade a futures wrapper or an options wrapper, everything is offset against each other. So the capital efficiencies become pretty significant, especially for the banks on the dealer side, but also for the buy side clients when they're looking at trading, emerging markets versus China versus Japan, or they're looking at developed, Eurostoxx 50 versus world or EFA. So the margin efficiencies become a pretty significant decision driver on trading on Eurex. Flexibility is another reason we offer flex options. So clients have the benefits of trading, customizing the expiry and the strike. So they can basically create flex options, which is also another benefit. You have better pricing. So you have, like Nicolas is on the panel with me, the dealers like that put price in the options market. Unlike the US ETF markets, which is very heavily driven only by the market makers, here you have a mix of market makers and dealers. So the pricing capability shows both tightness as well as size, because the dealers will show bigger size than just tightness. So you have that. And lastly, of course, there's always the benefit of less counterparty risk. So when you trade on an exchange, your exposure to another counterparty obviously is mitigated by the fact that the clearinghouse is always in between. So
interesting. And I guess the flex options offer a lot of the benefits of the OTC market in terms of the customization within the kind of environment of a listed market, of course. Yeah.
Right. Exactly. Yes. Yeah.
Interesting. Well, thank you very much. So Nicola, I want to bring you in now to look at the evolution of the options under MSCI. So where are the flows? Where do you see the flows coming from at the moment?
Good afternoon, everyone. So on the MSCI, we mainly have, I would say, two types of clients, with all of them having a specific needs. I would say the first one and the most important is the institutional clients. So where the target is mainly to protect the portfolio from an adverse equity movement. So they mainly use the option to hedge, like I would say, a macro view, and they're usually buying or selling the option to take advantage of the convexity of the payoff, so the asymmetry in the payoff. And secondly, we also have the hedge fund guys. So they are mainly trading the option based on the parameter view, so which is a bit different from the one coming from the institutional client. So they are mainly looking at the volatility, the skew, and sometimes at the div. So in terms of P&L or view from their side, it's a bit different. Like they're usually expecting a P&L coming from the change of volatility or from the realization of the spot move compared to the implied move. So it's a bit different.
Interesting. And we're going to come back to a deep dive into some of the specific strategies you see, but geographically, you've mentioned the two company types. Do you see any kind of trends in terms of geographical adoption?
I would say we are requested by almost everyone on the emerging markets. So the demand is coming from the US, it's coming from Asia, and also in Europe, because I think it's one of the best indices to hedge your, I would say, Asia exposure, except the Nikkei, for example. And for the developed market, the demand is mainly coming from the US. It's coming mainly from the way it's built. So on the developed market, it's mainly a US traded index, but it's trading during Europe hours.
And in terms of the differences between developed and emerging market contracts, what are they? What do you see there?
As I said, like I would say it's mainly coming from the constituent of the indices. So for the emerging market, I think it includes like most of the major developing countries. So we have China, India, as they said before, Korea, and Brazil. So the index is used by a lot of equity funds as a benchmark. So they are benchmarked on that. So they need to outperform this one. So we have asset manager coming to hedge their beta exposure on this index. And on the developed markets, I would say it's the most liquid index, like tracking the developed markets, ex-US, and also denominated in USD. So that's why US clients are mainly trading this one, because it gives them an exposure to the Europe market. And also, as we said, the MSCI World. The MSCI World is also like similar to the emerging market. It's used as a benchmark for most of the equity fund. So they use it for the hedging of the beta exposure.
Great.
Will,
yes,
do you mind if I jump in on this one as well?
Absolutely.
Yes, yeah. So on the next slide, I've also broken up EM and DM just to highlight that, because Nico was going to talk about it a little bit. But on the EM side, you can see Eurex list, the EM contract, obviously the EM contract, but also MSCI China, that's at the bottom of the slide. But you can see sort of that the whole segment has seen some growth. And what is interesting is that 45% of the business that we see here is real asset manager flow. So much to Nicola's point, it's coming from clients from Europe, from US, everywhere. And I think this is something that we are also collectively working on quite a bit. That's the emerging side. On the next slide, you will see it on the developed part. So IFA, again, as we talked about, is sort of the main benchmark that clients use. So that's on the very next one, the IFA options for non-US exposure. So everything which is Europe or Japan or Australia. And that's the main thing. But again, here too, almost 20 to 50% of the flow is really from buy-side clients. So here we do list IFA, Japan, World, Europe, all of those contracts as well. Just mentioning it out there.
Oh, fantastic. Nicola, you mentioned the hedge funds coming in. So what do you see in terms of the relative value firms trading the contract? Where's the opportunity for them?
For them, it's mainly used, like, I think we have two types of questions to ask ourselves on that. The first one is how and why they are trading that. So I would say there are many using like the option on the indices to fund their dispersion. So what are they playing is mainly the decorrelation versus the component. So when you're gonna play on the emerging market, you're gonna play on the dispersion between like China, India, or Korea. There are many coming for, I would say it's medium size. I will not call that small size. I would say medium size. So what are they trading? It's something like 100 million notional usually. Why they are not getting bigger on that? It's mainly to prevent themselves to have an adverse risk, because usually when they are trading this kind of option, they are playing like on the parameter. So what they want is to play the dislocation on this parameter, and even if the liquidity is good enough, if you come with a significant size, like you will face first more cost because you will be charged a bit more by the market maker and the dealers, but also you could push this parameter against you. So it's definitely what you want, like what you don't want to do. So what you want is keep the parameter where it is at the moment, and you wait until it's coming back to trade the other side. And the other question is, when are they coming? So for the dispersion trader, like they are coming when they think that the entry level is good. So it's mainly based on the most illiquid part, so usually on the stocks when you are trading the stocks dispersion. But also sometimes, like, we are interacting with them on the back of big client trades. So they are helping us, sharing a bit of the risk, because usually, like, sometimes the risk is quite big and it's difficult for banks to recycle this kind of risk otherwise. So they are bringing a bit of liquidity in the market. So we are transferring a bit of our risk with them. And it also helps them having like better entry point for their dispersion at that moment. Another way, like why they are also using this, is also to hedge like their macro risk in terms of volatility. So for example, if you have a basket of Chinese stock and it's like the market is closed in China, you think something is going to happen tomorrow, you can request this kind of option, and at least you can hedge your risk until tomorrow. Another use will be maybe to reduce your hedging cost, like, because hedging a stocks is definitely more expensive than hedging an index. So it's better to trade the index on that. Last but not least, I would say it also provides them another way to fund their dispersion. So just for example, most of the dispersion are based on the S&P, and we've seen a lot of hedge funds coming and selling or buying the MSCI World volatility in order to diversify their exposure in terms of dispersion. So it creates a new way and it reduces their risk on that.
Interesting. And then on the dispersion trade, how prevalent is that in the market?
Well, I would say we can't really quantify, like we can't say how frequently they are coming. It's a bit difficult because, as I said, it's mainly coming from opportunity. So on average, I would say they are coming 1 or 2 times a month. But yeah, it's not determined. It's mainly market driven. But one thing here is, as they are mainly coming to trade the listed option, we are usually requested in terms of like rebalancing the portfolio for the option, because as you know, for the dispersion, you need to keep the funding length in front of the stocks in case you are trading the stocks. So you need to rebalance your portfolio, and we are usually requesting on that.
Interesting. And in terms of what clients compare the contracts to, what's the benefit of trading a listed option versus other instruments as well?
I think Rachna has almost said everything on that. Like both indices are available in the US via the ETF, but we've seen more and more clients coming to trade the Eurex contract instead of the ETF. The first one, I would say the first reason will be because of the cost, because the costs are cheaper on the Eurex. But as Rachna already said, we are also providing liquidity via the flex option. So it helps a lot clients who wants like bespoke solution. So it's really helpful for them. And as I said, like the listed contract like is really, really important for the client because you don't face directly the bank, you face someone else. So you can have really, really good price without taking care, like without like needing to be careful on the counterparty. And for the banks, it's also a benefit to have a listed contract because when you want to offset a risk, like you can just go to see the dealers or the market maker and you can exactly offset your position in the market. So it's really helpful to be able to perfectly hedge yourself.
Interesting. And in terms of how flows changed, when you look at kind of longer and shorter tenures, what are the key points there?
Here it really depends on the client. Like I would say 90% of the flow is on the maturity less than 1 year. It's the one mainly traded. But depending on the client, you see different maturity. So the dispersion trader are usually coming on the maturity of less than 6 months. So it's really like spot move versus implied move here that they are playing. While we see the institutional client coming on the option that are less than 1 year in terms of maturity. So yeah, it's a bit different, but it's really, really, I would say similar. It's not that different. Something maybe we can mention here is that sometimes we have asset manager coming for the long-term exposure, so 2 or 3 years, and they are usually coming for big size, so it can be up to 1 billion. But as I said, most of the flow is coming on the short term here.
And in terms of from your perspective, how do you price the options?
That's the tricky part here. So even if you think that the MSCI is something really vanilla, as it's just a call or put, pricing them is definitely not. As I said before, it's like both indices are a basket of multiple regional indices that are transferred from a basket of regional indices to something denominated in USD. So we have, I would say, 2 more parameters that we need to take into account here. The first one is the correlation between the different indices. So for the emerging market, you're going to have some correlation between Chinese market and Korean market. But you're also going to have some correlation between the equity and the FX. So as the Korean market is transforming to USD, you're going to have some Korean won USD dependency with the Korean one. So I would say here the pricing depends on what maturity you are pricing. For the long-term option, it's really different from the short-term. On the long-term, I would say most of the parameters are observable and they are quite stable. So the index volatility can be easily observed. The long-term correlation can be easily observed with the exotic product, and they are quite stable. They are not moving from one day to another. It takes time to move from one implied correlation to another. While on the short term, it's definitely different. The volatility are moving like every day. And even when the local market are closed. So you're going to have to anticipate the move of the Chinese market depending on what's happening during the day. Otherwise, your price won't be good. So you're going to have to have a view on the volatility depending on the move during the European hour. And as I said, like we mainly use the exotic product in order to help ourselves to price the basket options here.
Yeah, interesting. And Russian talked a lot about the volatility, sorry, the liquidity growth that we've seen. So he's talked through the numbers, and we've seen strong growth in both volumes and OI. But from your perspective, how's the liquidity picture evolved?
I would say it's getting better and better. We are seeing more and more clients interest. So we have a really strong basket of clients that are trading quite frequently, but we also have more and more clients coming to request us on that. I think it's thanks to a lot of work coming from Eurex in order to make it as flexible as possible on that. Like, that's why the flex option has been created. And also it's coming from the time, like the sales spent explaining to clients like the indices. Because as I said, they are not tricky, but they are a bit more complex than usual indices. So you need to make the client confidence enough in order to trade that. So it's getting bigger and bigger, and I think it's only the start on that.
Right. Yeah. And sorry, Bashir, yeah, please.
Yes, and liquidity, I think Nicola hit it well, and Puneet mentioned it in the previous panel too. Liquidity comes in two shapes, whether it can be on screen, which some clients are biased towards seeing it on screen. So we have a market maker who's pricing it, but it also comes in the, when you call a dealer. So what we call in the block market or in the call around market. So just the main message here is that you have liquidity in both spaces. Just what you see on screen is not the only thing that you can get, especially when you're looking at doing size.
Absolutely. I guess kind of as with a lot of the options markets, that's a very similar pattern.
That's the way, yeah. Exactly, yeah.
Indeed. Okay, I just want to finish up with just some kind of real world examples of what you've seen in terms of how contracts traded during recent market events. I don't know if you can pick out a couple of examples and kind of talk the listeners through how they perform.
Yeah, definitely. So I would say for the emerging market, the main focus has been the Chinese market. As in China, we are speaking a lot of stimulus and rebound in the equity space. So like the portfolio manager are really, really following this, and how are they trading their macro view? It's mainly using the emerging market. So we definitely see a lot of demand for the upside option, like coming when I would say the government is speaking about like the stimulus in China. So it's definitely linked on that. And I would say another example would be for the developed market. So on the developed market, we've seen a lot of interest over the last 2-3 months, mainly coming from European clients. So the fear has been based on the European election. So in France, what happened is we've seen the dissolution of the French Assembly, and we had an opposition between the left wing and the right wing. And on the equity side, like the market was a bit bearish on the left wing. Why? It's because like on the left wing, they were speaking about increasing like the public spending, and it could have been an issue on the debt side. So both were, I would say, related. So we've seen the equity down, but also the FX down. So what happened is the euro was down at the same time as the equity, like the euro stocks. And what happened, as I said, like in the developed markets, is denominated in USD. So you would have benefit from a double effect, like the fact that the equity was down and the euro was down. It would have created a bigger return compared to the euro stocks. And we've seen a lot of, I would say, portfolio manager using MSCI as a good proxy to play this scenario. So they were buying like the downside option in order to hedge this risk. And we also have seen like the hedge fund playing the correlation with that. So they were playing a higher realized correlation between Euro stocks and Euro USD here.
Interesting. And how does the pricing change during periods of volatility? What do you see in that respect? Obviously, you're trying to be in the market as much as possible, but what can people expect to happen with spreads, etc., when markets get rough?
Yeah, as I said before, like the pricing involves a lot of parameters, and often like most of them are not observable even for the bank. So it's even more difficult for us during shaky market because like all of them are moving a lot. It has been the case early August when like we've seen the equity market down. But I would say even if the bid offer like here are a bit wider, the liquidity is there, and we've seen a lot of dealers involved to provide some liquidity in the market. So in terms of liquidity, I would say we're gonna have smaller trades, but more frequently. Like people are trading more and they are trying to catch the different opportunity. And a lot of clients were here also to request us on that. So liquidity is definitely not really impacted during this kind of event.
Interesting. Well, we're almost up against time, but Roshan, I just want to come back to you with some kind of final thoughts. It's Nicolas painted a kind of very interesting picture of a diverse market that's growing well and providing a lot of opportunities for buy sides to hedge, but also for hedge funds to gain exposures. What are your final thoughts just on the discussion we've had today?
Yeah, thank you, Will. I mean, I also look at the whole MSCI segment, so maybe I can speak on it generally. I think the three messages I would like everyone to sort of walk away with is one, that we offer the whole breadth. So whether you're looking at emerging markets, you want to look at the regional indexes at EM that we talked about quite a bit, or you want to look at it from a country lens, China, India, Brazil, you have all of that exposure. On the developed side, you can look at MSCI World, you can look at IFA, you can look at Japan, USA, Canada. So the first thought that I would like to leave everyone is that you have the breadth available to you if you want to take a listed exposure, whether it be on the option side or on the future side. The second thing is liquidity. So Nicolas spoke quite a bit about it as well. There is always liquidity available. So there is liquidity on screen, there is liquidity on size in the block markets. Both is there. So, don't just sort of look at what's there on screen and get deterred by that, because there's a lot of it behind there as well. And the third thought is really is the fact that Eurex is very well poised, because we cover the Asia time zone, starting from Singapore open to Europe to the end of US close, and actually even a little bit beyond US close. So when market events happen, you are actually able to capture this at any particular point in the trading day. You are not beholden to only a certain time window. It all nets into the same pool. The whole liquidity sort of ultimately lands up in the same place. So that's definitely giving every client the flexibility to do what they would like to, at obviously the time that they're awake, and managing that risk. So.
Fantastic. Well, yeah. Nicolas, thank you ever so much. That was a great tour through the options market. So we're now going to take a 5-minute break. So for those of you listening, go make a coffee. When you come back, you'll be prompted to click on the section 2 link, which should be on your screen. You can stay on the screen, but it means you won't be able to ask questions if you don't. So we'll be back in 5 minutes to join for part 2, where we're going to be taking a look at total return futures within the MSCI complex.